Hi everyone. Let me paint a quick picture for you. Imagine you running a growing business. You've got a team. You're working with vendors, maybe even expanding across cities. Money is moving constantly. Travel bills, reimbursements, rewards, payments, you name it. Now ask yourself, how do you keep track of it all as a company? Not just who's spending what, but where, why, and how much in real time, without the chaos of spreadsheets, emails, or endless approvals. Now, that is a problem many modern companies are facing, and that's exactly where a new wave of innovation is stepping in. It is not just about digital payments anymore. It is about smarter tools that help businesses control, analyze, and optimize every rupee they spend. Tools that combine finance and technology in a way that is super intuitive and powerful. So this space is growing fast in India. It's where fintech meets software, designed specifically for how companies operate today. And there's one player in this space that's really making waves. They've built a system that goes beyond just payments. It brings visibility, control, and rewards into a single platform, which is tailored for businesses of all sizes. Curious? Stick with me. You are about to see how they are changing the way companies think about spending. In this video, we shall look at the business overview of the company, followed by the product lineup and technology, the financials of the company, market landscape, governance and risk, and assessment with respect to investing in the company. Now, before we dive in, let us quickly clear up a term which you will hear a lot in this space. That is SaaS, which is also known as software as a service. Now, simply put, SaaS means software that runs in the cloud. You don't download or install it. You just log in through your browser, pay a subscription, and start using it. So think of tools like Google Workspace, Zoom, or Salesforce. All are examples of SaaS. So for the sake of simplicity though, I won't keep saying SaaS throughout this video. Just know that this company is offering cloud-based tools or platforms using the SaaS model in the fintech space. Alright, let's take a closer look at the company we have been hinting at, Zaggle. So what exactly do they do? At their core, Zaggle offers a digital platform that helps businesses manage spending. Think of it like a smart control center for corporate finances. Through their platform, companies can issue prepaid or corporate cards, track employee expenses, reimburse quickly, manage vendor payments, and even run rewards and incentive programs for their teams, all in one place. Zaggle mainly works in the B2B space, meaning their platform is built for other businesses, from startups and small businesses to large corporates. They are not focused on individual consumers, but on helping companies gain better control over their spending and financial operations. This company was founded by Mr. Raj Fani Narayanam, an entrepreneur with experience in both India and US. He started Zaggle back in 2011, so the company has been around for over 14 years now. The current CEO, Mr. Avinash Godkhindi, has a strong banking background with stints at Citi's, Barclays, and ING before joining Zaggle in 2012. Zaggle is no longer a startup operating in the shadows. In September 2023, they officially went public and is listed on the National Stock Exchange and the Bombay Stock Exchange. So overall, it is a homegrown fintech player focused on businesses, offering tools that make it easier to manage money, automate workflows, and reward people, all from one powerful platform. Let us take a quick look at the market Zaggle operates in and why it is such an exciting space to watch. Zaggle works in a specific niche within the fintech world called spend management. In simple terms, they help businesses keep track of how money is being spent. Now here's the big picture. India's digital finance landscape is booming. Spend management tools like the kind Zaggle offers are quickly becoming a must-have for modern businesses. In fact, the total market for spend management software in India is expected to grow from around rupees 73 billion in 2023 to about rupees 131 billion by 2027. Now, this is a strong annual growth rate of roughly 25%. Zooming out, the broader Indian fintech industry is already valued at over rupees 7.1 trillion and is expected to continue growing at 30% annually. So the space is not just growing, but it is exploding. As for Zaggle's position, while exact market share figures aren't public, Zaggle currently works with over 3,300 businesses and serves more than 3 million users. That gives them a strong leadership position in this niche. So what is fueling this growth? More and more businesses are moving away from paper, spreadsheets, and manual approvals. They want smarter, faster, and more transparent tools to manage money. That's exactly what platforms like Zaggle deliver. Also, the company is expanding beyond just expense tracking. They are now offering invoice to pay systems, reward platforms, even forex and corporate credit solutions. So they are not just growing with the market, but they are helping to shape it. And of course, there are regulatory changes on the horizon too. India is encouraging digital finance through UPI, e-vouchers, and other initiatives. At the same time, companies like Zaggle will need to stay on top of compliance as rules continue to evolve. Zaggle offers a comprehensive suite of SaaS-driven solutions covering everything a business needs to manage spend. Here's a quick roundup. Zaggle Propel. Now this is a product that makes rewards hassle-free. Now traditionally in a company, HR teams manage rewards manually, tracking performance across spreadsheets, coordinating with finance, and sending gift cards individually via email or physical delivery. Now this process is time-consuming and fragmented. Zaggle Propel transforms this. With a centralized platform, business can launch reward campaigns effortlessly, define the criteria, set the targets, and the system automates the rest. Now whether for employees, sales teams, or channel partners. For example, if you are running a company, so instead of sending rewards to 200 sales reps manually, a single campaign ensures that everyone receives their reward instantly through the platform, and it is tracked, recorded, and hassle-free. The next product is Zaggle Save, which helps in fast expense reimbursements. Now, traditionally in companies, employees have to fill out spreadsheets, scan receipts, and email finance teams and wait for a long time for reimbursement. Meanwhile, the finance teams who receive the claims, they are stuck reviewing the claims one by one. Now, what this product does is that it eliminates the friction between the employees and the finance teams. Employees can now submit expenses digitally, capture receipts via mobile, and get reimbursed faster. There are tax-saving benefits also like meal cards and fuel allowances, which are integrated into the same product. So now the employees don't have to worry about stapled bills or lost receipts. They just have to snap a photograph, upload, and track the claim in real time. So it is as easy as using a food delivery app. To make vendor payments in a company, the finance team often struggles with multiple tools, go through Excel sheets, and manually process vendor payments with limited visibility and high error rates. So the next product, that is Zaggle Zoyer, aims to overcome all this. So this product brings everything into one place with real-time dashboards, automated approvals, and embedded payment options. So the finance teams now gain complete visibility and control of the vendor payments without switching between platforms. Another problem in spend management is overspending, and many teams often discover this at a later stage and they have limited ability to act at that moment. So the next product, that is Zaggle Zati X, aims to put a control in real time on overspending. With live dashboards, configurable controls, and instant alerts, managers can now allocate budgets by team, project, or region and respond to overspending even before it happens. Say for example, a company is running a digital campaign. So this product notifies the team the moment the daily spend limit is breached. Now this allows instant adjustment and cost control. Next product offered by Zaggle is for companies dealing with fleet management. So sorting out fleet expenses often means handing out fuel slips or cash with minimum visibility or control. So tracking consumption and verifying usage becomes a manual and error-prone task. So with this product, that is Zaggle Fleet Management, each vehicle is assigned a preloaded card with real-time tracking of usage, transactions, and mileage. So all visible through a unified dashboard. For companies making payment overseas, so a cross-border payment typically involves bank visits, forex markups, complex paperwork, and compliance headaches, especially under RBI regulations. The next product, that is Zaggle International Payments, simplifies this process. Businesses can upload invoices, make payments digitally, and receive all necessary compliance documents automatically. There are no bank queues, there are no manual forms. To enhance the delivery of its products, Zaggle uses prepaid cards as a product delivery mechanism. Its prepaid cards are smart spending tools that businesses give to people. Not just employees, but also to gig workers, drivers, or even to external partners. The goal is to make business-related spending controlled, easy, and trackable. So these aren't regular debit cards. What makes them different is that the company can decide exactly how and where the money on the card can be used. For example, there might be money on the card, but it is only for food, so you can't spend it on anything else other than food. Another card might be limited to fuel or gift purchases or mobile top-ups. So this makes it super useful for things like employee benefits, rewards, reimbursements, or travel expenses. Now here's where it gets even more interesting. These cards aren't standalone cards. They are fully powered by Zaggle's SaaS platforms. That means all the logic, like who gets how much, for what, when, and why, is handled by Zaggle's software in the background. So for example, the Zaggle Save platform is used to manage expense reimbursements. When a claim is approved, the money is loaded right onto the card and it is ready to use. Similarly, Zaggle Propel, which is used for rewards, now run a campaign and winners get their gift value instantly on the card. Even with the fleet management, drivers don't carry cash. Instead, they use prepaid fuel wallets and every transaction is tracked. So to put it simply, the cards are the smart delivery mechanism and the SaaS platforms are the brain behind it. Together, they help businesses spend better, stay compliant, and cut down manual work. Similar to prepaid cards, Zaggle also offers tap and go variables. Now the product is Zaggle Zaki and it resembles a keychain or they are key fob style variables that work like gift cards. So employees or partners can tap these variables to redeem rewards. Zaggle also offers global corporate cards via Mesh. Now this is through a partnership with US-based Mesh Payments. Zaggle now enables companies to issue global cards for use across US, Europe, and Latin America. So these can be credit, prepaid, or forex cards, all managed on a single platform. Companies which have teams in multiple countries, say for example India and US, they can now issue cards for both regions with one unified system and track spends globally. The biggest strength of this company is that it is providing all its products together into one smooth, all-in-one kind of platform. So instead of using one tool for expenses, another for vendor payments, and yet another for rewards, businesses can manage it all in one place with Zaggle. Zaggle's core software is developed in-house. It is not just a plugged in from third-party tool kind of a thing. So this gives them full control over features, faster fixes, and a smoother, more integrated experience. The products are also user-friendly by design. The platform is modern, mobile-ready, and easy to use. No manuals or technical training is needed. From finance managers to sales representatives, anyone can log in and get things done fast. It is also scalable and modular. It is cloud-based and built for scale. Zaggle serves thousands of businesses and millions of users. It works for startups and enterprises alike with modular products like Save that grow with the customer. Their recent US expansion also shows that they are growing globally. And there is the smart engine that is the ZatiX. The ZatiX is the Zaggle's proprietary analytics engine which powers real-time insights and fraud detection and smart budgeting. It learns from millions of transactions, giving finance teams an intelligent edge. Zaggle has built a real moat around their business. Here's what makes them stand out. The tech isn't off shelf or pieced together. It is all homegrown. That means they can move faster, fix things quicker, and launch features on their terms. So with millions of transactions flowing through their platform, they have a deep, growing pool of insights that competitors just don't have. Most companies don't use just one Zaggle tool. They end up using several since they have packaged it as an ecosystem. And once they are in the ecosystem, they tend to stick around. And it is built to be secure. That is, from encryption to compliance, the company has designed to meet serious business standards right out of the gate. So put that all together and the company has a tech moat that is hard to copy. Having seen the product portfolio of the company, let us now see who are their clients. Now, Zaggle isn't for individuals. It is built for businesses. Their clients range from startups and small companies to big names in banking, tech, manufacturing, healthcare, and retail. But here's the twist. Even though they sell to companies, millions of employees, vendors, and partners end up using Zaggle's tools. So it is a kind of ripple effect that is called B2B2C model, or business to consumer model. That brings us to the next question. How does Zaggle make money? Zaggle has multiple ways of earning, which is great for business stability. Let's break it down. And we will talk about how much each stream contributes to the revenue. So let us start with SaaS subscriptions. Now, companies pay a regular fee to use Zaggle's platforms like Save, Propel, and Zoyer. This brings in around 33 to 35% of the total revenue. The next stream of revenue is card transactions. So when someone uses a Zaggle issued prepaid or corporate card, Zaggle gets a cut from the payment networks. This is their biggest chunk of revenue. It contributes roughly 45 to 50% of the total revenue. The third stream is rewards redemption. Employees use reward points through Zaggle's Propel system, and Zaggle earns a fee each time someone redeems. So this accounts for about 10 to 12% of the revenue. The fourth stream is the extra services, or we can say the value added services. They also make money from things like forex services, credit card partnerships, and leasing devices for corporate use. So these add-ons make up around 5 to 7% of their total income. So in short, we can say cards contribute 50%, SaaS subscriptions 35%, rewards 10 to 12%, and extras is about 5 to 7%. So the variety keeps their income diversified and more resilient. Even if one stream slows down, the other help balance things out. As you have already seen, more than 50% of the revenue comes from Zaggle's card business. So it is important to talk about the card business. By the end of FY25, Zaggle had issued over 50 million prepaid and corporate cards. Now this is a massive number. These cards are being used by around 3.2 million users across more than 3,200 corporate clients. So the user base is growing, which means companies are actually using these cards for expenses, rewards, or payouts. The annual revenue per card comes out to be approximately rupees 260. Now this might seem to be a small figure, but given the volume of the cards, the revenue generated would be colossal. Since Zaggle isn't a licensed bank, it needs partnerships with banks to operate in the fintech space. The banks handle the regulatory side, things like compliance, card networks, and payment rails, while Zaggle focuses on delivering the platform, features, and user experience that companies rely on. So Zaggle works with 14 to 16 banks through non-exclusive partnerships. These banks aren't investors or owners. They are service partners that provide the infrastructure needed to issue prepaid and corporate cards and to handle payment processing. So what makes this model smart is that it is collaborative, it is not restrictive. Zaggle isn't logged into any single provider. That gives them the flexibility to scale faster, offer customized solutions to different clients, and even expand into new markets more easily. So while banks play a critical role behind the scenes, Zaggle stays in control of the customer-facing product. This setup allows them to grow efficiently, adapt quickly, and remain agile in a fast-moving industry. I came across this flywheel representation of Zaggle's business ecosystem in their investors presentation. So at the center, we have Zaggle, which is connecting the 4 key players of the ecosystem, that is corporates, partners, merchants, and employees. Now, how do corporates contribute to the ecosystem? They are the ones who are using Zaggle software to manage spending and reward their teams. So in return, they pay the subscription fees for SaaS, and they bring in users like their employees who use the platform. Now, partners like banks, Visa, and MasterCard, they help Zaggle run smoothly by reselling the platform and offer essential infrastructure. So from them, Zaggle earns the program fees. Merchants accept payments from Zaggle users and often offer deals on that. So they help complete the ecosystem and pay commissions for user transactions. Finally, the employees, who are the everyday users, they spend on the platform, driving volume. From them, Zaggle earns through value-added services like lending and various financial products. Now, the beauty of it is, the more corporates join, the more users come in, leading to more spending. Now, this attracts more merchants and partners, and this is the network effect in action. So the model being B2B2C, that is, businesses are the clients, but the value ultimately reaches the end consumers. Now, big names like Siemens, IIFL, Tech Mahindra, and White Oak are already on board, and they are backed by top partners like HDFC, Kotak, Visa, and RuPay. So Zaggle isn't just a spend platform, it's a full ecosystem. Let us see a few more details about Zaggle using screener.in. The company was trading at rupees 413 per share as on 1st July 2025. It is listed both in Bombay Stock Exchange as well as National Stock Exchange and has a market cap of 5,542 crore. So it is a small cap company with a 52-week high of rupees 597, 52-week low rupees 281. It has a PE of 63.4, which is a bit on the higher side as compared to sector median PE. The book value rupees 93. So it is trading almost 4.4 times its book value. So seems overvalued. ROCE at 13% and ROE at 9.6%. Looking at the chart for past 3 years, we can see that the stock had a strong upward trend starting around early 2024, gaining momentum and hitting a peak above rupees 550 by early 2025. After that, the stock corrected sharply, dropping below rupees 350. Recently, it has started recovering again and is now trading above rupees 400. The orange line, which is the 50-day moving average, has started to curve back up and is crossing the gray line, that is the 200-day moving average. Now, this is often a bullish sign and is also known as a golden crossover. We can also notice the volume spikes during these moves. This tells us that investors were actively trading during those turning points. So basically, it shows that the buying interest is still there. And overall, it looks that the stock is gaining strength again. Some pros and cons listed in the website. Good profit growth of 88% CAGR over the last 5 years. It's a big positive. And promoter stake increased by 4.12% over the last quarter. Now, this is again a good news. Looking at peer comparison, we can see that Zaggle, being a small cap player, has a market cap of just 5,541 crore, which is much less than the market caps of the peers listed in the table. Also, the PE at 63.35 is much above the sector median figure of 35.73. The ROCE is at 12.99, which is below the sector average of 15.36. However, the positive is that the net profit quarter, that is Q4 FY25, is 31.96 crore, which is quite comparable to the peers listed here, and it is much above the sector average of 10.96. However, this comparison may give only broader insights because Zaggle is a company working in the fintech space. It is a SaaS player focused on spend management, whereas the companies listed here are not focused onto this niche area. So the comparison may just give broader insights. Let us break down the quarterly results. Revenue is growing fast. It jumped from rupees 89 crore in June 2022 to rupees 411 crore in March 2025. Now that is almost a 5x increase in less than 3 years. Expenses have also gone up, but at a slower pace. Operating profit has improved from rupees 11 crore to rupees 37 crore, and margins are steady at 9 to 10%, shows consistent performance. Other income, like interest or small investments, is small but increasing, especially in the last few quarters. Both interest and depreciation are under control, with interest falling to rupees 1 crore by March 2025. The profit before tax has more than quadrupled from just rupees 9 crore to rupees 42 crore. Now this shows how fast profits are scaling. Tax rate is steady around 24 to 28%, so nothing unusual there. Now the most important part, net profit rose from rupees 6 crore in June 22 to rupees 32 crore in March 25. Now this is a strong and consistent growth. EPS has gone from rupees 0.82 to rupees 2.38. Now that is the money that shareholders earn per share, and it is a good sign when it is rising steadily. So overall, it has shown strong revenue growth, controlled expenses, rising profits, and healthy earnings per share. So this is a scaling company with it's showing signs of momentum. The P&L performance over the last 6 years shows massive growth from just rupees 68 crore in FY20 to rupees 1303 crore in FY25. Now that is almost 20x jump. Expenses have also gone up, but Zaggle still managed to grow its operating profit to rupees 115 crore in FY25. They also earned rupees 25 crore from other sources in FY25. Now that is likely interest or investments. We can see a huge leap in net profits. It grew from rupees 4 crore in FY20 to rupees 87 crore in FY25. EPS is up to rupees 6.52. It reflects the company's profitability per share, and also we can make out the trend, which is clearly going up. Dividends have not been given yet. So overall, the company shows explosive growth, improved efficiency, and a strong bottom line performance. Supporting this growth story are some performance highlights. Sales growth over the last 5 years, sales have grown at a CAGR of 80% and 52% over the last 3 years. So even in most recent 12 months, the trailing 12-month growth is 68%. Now that is strong and consistent growth. Profit growth, over 5 years, it has grown at 88% CAGR, and in the last year alone, it is up 99%. Now that shows company scaling efficiently. In the last 1 year, the stock price growth has been 40%, which is not bad for a relatively new listing. ROE tells us how well the company is using shareholders' money. So it is 12% over 3 years and 10% last year. Now that is decent, but there is some more room to improve as the company grows. The balance sheet also supports the growth story. Equity capital has gone up from 0.18 crore in 2020 to rupees 13 crore in 2025. Reserves from negative rupees 65 crore in 2020 to rupees 1234 crore in 2025. Now this is a huge turnaround. This shows strong profit retention and improved financial health. Borrowings, debt peaked at rupees 141 crore in 2023, but dropped sharply to just rupees 16 crore in 2025. That means most of the debt, most of the loans has been repaid, which is a good sign. Total liabilities and assets both grew from rupees 49 crore in 2020 to rupees 1308 crore in 2025. Now this is massive growth in scale. Fixed assets and investments, fixed assets jumped to rupees 126 crore and investments rose to rupees 82 crore, showing they are expanding operations and deploying capital smartly. Other assets grew to over rupees 1100 crore. This likely includes cash, receivables, and digital assets. So overall, it shows growth, debt reduction, and a strong jump in reserves. Let us take a look at the cash flow. Operating cash flow tells us if the business is generating real cash from its operations. It has been inconsistent with negatives in FY23 and FY24, but positive again in FY25 with rupees 20 crore. Now this is a good sign. Investing cash flow, now big negative numbers here, especially in FY24 and FY25. That means the company is investing heavily, maybe in tech or platforms or infrastructure. Financing cash flow, they have raised a lot of funds, rupees 403 crore in FY24 and rupees 496 crore in FY25. So this supports the expansion. Net cash flow, the company ended FY25 with rupees 30 crore positive net cash. So despite high investments, we can say that the cash is being managed well. Key ratios. Debtor days came down to 60 from 82 last year, meaning they are collecting money faster. Now this improves cash flow. Cash conversion cycle also down to 60 days, which shows better efficiency in managing receivables. Working capital days has improved from 129 to 100, meaning the company is managing day-to-day operations more smoothly. The return on capital employed dropped from 33% to 13%. Now this suggests that returns are a bit diluted, probably due to large capital inflows and recent expansion. The shareholding pattern reveals that promoters hold 44.21% of the shares, FIIs have 8.44%, and DIIs 13.26%. Now, public is holding a relatively large portion at 34.09% of the shares. There has been an increase in the promoter stake to the tune of almost 4%, which is a good sign. And there has been a commensurate decrease in the stakes of the institutional investors and the public over the last 1 year. Now, this is a good sign. Amongst promoters, Mr. Raj Narayanam, who's the founder of the company, holds about 34.39% of the shares. It is notable that amongst various shareholders in public, Mr. Ashish Kacholia, who's known for his knack for picking multi-bagger shares, holds a stake of 2.24%. The price to earning ratio of 63.4 is slightly on the higher side, but when we look ahead, the forward PE drops to around 36 due to strong earnings growth expected in FY26. Also, the PB ratio is around 4.4, but for a company like Zaggle, which is asset light, SaaS and Fintech focused, and built on intangibles like software and data, book value doesn't really capture the true value. That is why PEG ratio is more relevant here, and it reflects the actual performance and growth potential. So the PEG ratio comes out to be 0.92 to 1.15, assuming an EPS growth of 65% to 52%. So it means Zaggle could be fairly valued or even slightly undervalued given its growth potential. So the bottom line is that initially the high PE may not make sense, but when we see it in conjunction with the PEG ratio, the valuation makes more sense. Zaggle has been actively growing through strategic acquisitions. It has made 4 strategic bets, each adding value to their platform. First up, mobileware technologies. Zaggle has picked up a 38% stake for 23 crore, and this one is about strengthening their UPI and real-time payment systems. This is essential for their fast card and reward disbursements. It was funded internally before their QIP. FESoft is the next company in which they have bought 51% stake for rupees 41 crore. This company does POS billing and e-invoicing. It helps Zaggle integrate retail data and merchant engagement tools. So it is useful for the rewards and analytics engine. GreenEdge Enterprises, Zaggle has bought 100% stake for rupees 27 crore in this company. It is a niche player in golf travel and curated experiences, and it has added luxury and lifestyle rewards into the Zaggle Propel platform. And finally, Dice Technologies, the biggest deal so far, 100% acquisition done by Zaggle for rupees 123 crore. Dice is an AI-based spend management startup from Pune, offering tools for travel and expense, and it directly boosts Zaggle's SaaS capabilities. So this was fully funded through the QIP proceeds. In expense and spend management space, Zaggle's key rival is HapPay. This is highly rated. Then we have global giants like SAP Concur, Zoho Expense, Expensify, File, Ramp, Pleo, and Divi. So these are all strong in travel and corporate card management. Even Spendesk and Ramp are cited in CB Insights as emerging fintech competitors. So Zaggle competes across multiple categories, and its biggest advantage is that it provides its products as a single ecosystem. So for employee and channel rewards, Propel takes on in-house tools and sales incentives platforms. With Dice now integrated, They challenge SAP Concur and Zoho Invoice in vendor payments. And for prepaid and international cards, Zaggle competes with Brex, Pleo, and similar global fintechs. Now, what makes Zaggle stand out is their all-in-one model, which includes SaaS tools, corporate cards, rewards and loyalty, vendor payment automation, and all. And of course, their hybrid go-to-market strategy, combining digital, partnerships, and banking channels, which gives them a reach across sectors. For distribution, Zaggle doesn't just rely on ads or direct sales, they use a multi-channel approach. Through Zaggle Propel, they help companies run dealer and distributor reward programs, building strong B2B networks. Their blogs and resources support partner engagement and co-selling. On the tech side, they have partnered with Mesh Payments in the US for global corporate card issuance. They also integrate with banks, ERPs, and HR tech platforms to reach to clients where they already work. Before we talk about some key risks and challenges that Zaggle faces, let us quickly review some acronyms. The first one is NPCI. NPCI stands for National Payments Corporation of India. It is an umbrella organization which was set up by the RBI and the Indian Banks Association, and this operates retail payment systems in India. It functions as a central infrastructure provider for digital payments in India and manages platforms like UPI, RuPay, and BBPS, ensuring safe, efficient, and inclusive digital payments. The next acronym is TPAP, which stands for Third Party Application Provider. So it is a fintech or app provider which is authorized by NPCI to offer UPI-based payments. Now, such organizations generally rely on a partner bank for transaction processing. PhonePe, Google Pay, Amazon Pay, and Cred are examples of TPAP. The third acronym is BBPS, which stands for Bharat Bill Payment System. It is a centralized bill payment system which is run by NPCI that allows consumers to pay utility and service bills through any registered outlet or digital channel. It supports multi-payment modes and offers real-time confirmation. The last one is PCI-DSS, which stands for Payment Card Industry Data Security Standard. Now, this is a global security standard which is designed to protect cardholder data during processing, storage, and transmission. Companies handling card transactions like Zaggle must comply to their secure payment environments. Let us now understand the risks and challenges which Zaggle faces. First, the regulatory environment. Zaggle operates under RBI and NPCI rules, and it is a TPAP, which means higher expectations around system uptime and data security. They follow global standards like PCI-DSS, but because the fintech space evolves so fast, new compliance changes could delay product updates or add complexity. The next is the competition itself. Zaggle goes up against traditional banks, BBPS platforms, and new wave of fintech startups bundling enterprise resource planning and payments together. So bigger players with deeper pockets could copy Zaggle's features, but tools like Save and ZatiX still give them an edge as of now. Then there is the cybersecurity angle. With so many transactions and cards flowing through their systems, fraud is a real risk. They've taken strong steps like encryption and compliance, but in fintech, threats are always evolving. So how is Zaggle defending itself? They have built a modular platform, which means once a business starts using one product, say for example Save or Propel, it is easier to cross-sell other products. Now this boosts retention and reduces churn. Also their acquisitions like FERSoft or Dice, GreenEdge, etc. They haven't just added to the scale, but they have deepened Zaggle's tech stack and backend strength. So yes, there are risks, but they are managing them with relevant product strategies, regulatory focus, and strong client integration. Let us do a quick technical check on Zaggle using this weekly chart. Let us look at the price trend. The stock is currently trading around Rs 413. That is after a recovery from its recent lows near Rs 290. So we have some strength building up again after a steep drop. Checking out the 52-week high and low. 52-week high is showing as Rs 581 and the low at Rs 289. Now this is a pretty wide range, which means there can be volatility in the price of the stock. Next, the volume bars we are looking at the weekly candles here. So those green and red bars at the bottom show how much trading activity was there. Notice the green spikes during the price rise. Now this is a healthy volume which is supporting the upward moves. Now let us move to the MACD, which helps us spot momentum. We can see the blue line is crossing above the orange line, which is the signal line. That is usually a bullish sign, meaning momentum might be turning upward again. Positive histogram bars also support that. Looking at the RSI is the relative strength index. It is sitting around 52, which is right in the middle. It is not overbought nor oversold. So the stock isn't looking too expensive or too cheap technically. That gives it room to move either way, but there is no red flag as of now. Levels that I am watching. First, on the downside, I am keeping an eye on rupees 384 to rupees 385 zone. The stock has spent some time hanging around this area recently. So if it dips and bounces back from here, it might be a good sign of support. Then there's a deeper support zone around rupees 364 to rupees 365. If it turns a bit shaky, this level could act like a safety net. If it holds here with strength, it might offer a better entry point, especially for those who are looking at it from a long-term perspective. Now on the upside, the first level I am watching is rupees 510. That is a key resistance, kind of a ceiling the stock has struggled to reach before. If it breaks through that, then it could further reach 560 and 612 levels also. Let us take a quick look at the leadership. At the top, we have Mr. Raj Narayanam, the executive chairman and founder, a seasoned entrepreneur with strong product instincts. Along with him is Mr. Avinash Godkhindi, the managing director and CEO, who brings solid fintech and digital banking experience. On to the independent directors, Mr. Arun Vijay Kumar Gupta comes with experience in finance and strategy across corporate boards. Mr. Arav Mundan Krishna Kumar is a former SBI managing director, a strong name in banking and regulatory compliance. Mr. Abhay Deshpande is a well-known figure in India's startup ecosystem. He founded MartJack and is a tech entrepreneur. Mrs. Prerna Tandon adds diversity and HR insights with corporate leadership experience. And Mr. Virat Sunil Devanji has a deep knowledge of legal and governance issues, often sitting on audit and compliance committees. So this is a solid spread across banking, fintech, legal and startup domains, which is great for a SaaS plus fintech player like Zaggle. Though I feel the board could still have had more presence from regulatory veterans or maybe cybersecurity experts, especially considering the digital and payment risks that this company faces. Let us break down the pros and cons for Zaggle, starting with the positives. First up, strong management. Zaggle has a board which is led by the founder, and the board is experienced in fintech, banking, and enterprise software. So this gives it execution strength. Second is its profitability and net cash positive. Now, the company is growing fast and it is already profitable and generating positive operating cash flow. Also, for FY26, the company has given a guidance for 35 to 40% revenue growth, while also targeting EBITDA margins of 10 to 11%. Now, this is a big green flag. Also, the diversified revenue stream in which the company earns software subscriptions, card transactions, rewards, and even they earn from the analytics. So it is not dependent on one line of business. Their modular scalable platform means clients can start small and later on expand. So products like Save, Propel, and Zoya are designed to integrate and scale, which makes switching away harder and retention stronger. Also, client retention is another positive in which they have a churn which is less than 2%. So it means clients stick around and it is a good sign that the platform is delivering value. Then there's this banking ecosystem integration in which they work with over 14 banks in a non-exclusive model. So they are not tied to any one partner. It adds scale and reduces financial risk. Smart acquisitions have also helped in which they have bought stakes in companies like Dice, FESoft and Mobileware, strengthening their tech stack and opened up new markets like the POS and the invoice to pay. Finally, they are playing in a growing market, that is the spend management, and the fintech market in India is expected to double in the next 3 to 5 years. So we can say that the company is in the right space. Talking of cons, firstly, it has relatively low brand visibility. It is well known in corporate circles, but it is still not a household name like some other fintech companies. So this could limit sales and growth unless it is addressed. Next is the cybersecurity exposure. With millions of cards issued and tons of transaction data flowing through the systems, they have to stay a step ahead of the cyber threats, even with compliance in place. Also, since a chunk of the revenue comes from the card business, so this assumes importance. Then there's the regulatory complexity. As TPAP under NPCI and under RBI rules, they operate in tightly controlled space. So any policy change or any lapses could mean delays or higher cost. There's this margin pressure from the card business. A big chunk of the revenue comes from interchange fees, which are low margin compared to the software. So profitability can get squeezed as volume scales. Competition is heating up. Banks, fintech companies like HapPay and Zoho, global players like SAP Concur and Ramp, they are all in this space, and replication is a real risk. Also, the stock is trading in high valuation multiples. It has a PE of over 65 and it has premium valuation, all based on EPS growth projections of 65% to 52%. Now, any earning misses is a big red flag which could lead to the stock taking a hit. Taking it all around, I feel this company has a solid business model, which is SaaS plus fintech with modular products and strong retention, positive cash flows. So this is rare in this space. And of course, the numbers look credible. The acquisitions are thoughtful and revenue mix gives them protection against market swings. But then there are real concerns like high valuation multiples, regulatory landmines with RBI and NPCI, and margin pressures from their card-heavy business. Also, it is not yet a very popular name, which might slow down enterprise growth unless they push the brand harder. So, if I had to think about the entry points, my levels would be somewhere around 384 to 385, where there seems to be a decent support base. If the stock dips there and holds, it might signal accumulation. A bit lower, 364 to 365, that would be the deeper support zone. On the upside, I shall look at 508 to 510 levels, and if it crosses that level with good volumes, then the next maybe 560 and even 610, 620 levels. Since the stock is already trading at a PE of 63, so it has to keep delivering, and any earning misses would be a big red flag. If you have a question or want to deep dive into any stock, please drop a comment below. Thanks for watching and happy investing.